This introductory video on the mortgage market gives you a quick read on the types and descriptions of mortgage loans in the United States, which, as you can see here, the volume of loans issued by lending institutions has grown remarkably over the years. We did have a hiccup right here, and you know what that is, the 2008 global financial crisis. Mortgage loans could be for business or it could be for homes. If it is a home mortgage, you might want to take out a fixed rate mortgage, which gives you a fixed interest rate over the term of the loan, or adjustable rates, which allows the interest rate to be adjusted periodically depending on the terms agreed upon. Fixed rate loans are usually for 10, 15, and 30. All right, 15 and 30 are going to be the most conventional. And like I said, it could be a fixed rate mortgage or an adjustable rate mortgage. Now, though, your mortgage loan could be a conventional home mortgage issued by banks, and or they could be government-backed mortgage loans. They are also issued by banks, but they are guaranteed by government agencies right there. So your loan could be an interest-only mortgage. This is kind of unusual. In this case, the borrower pays only interest on the loan, and no portion of the principal is repaid. But you know what that means? Any the principal that's not that you took out stays there. I mean, like a luggage, yeah, because at some point you're gonna have to pay it back. All right. So it could be a subprime mortgage loan, meaning that the borrower has a low credit score. Usually, if your FICO score is below 600, then you really are trending in the negative territory as far as the quality of the loan that you're seeking is concerned. Um, Negative amortization loan, that's another oddity right here. All right, in this case, the loan agreement allows you to pay interest payments that are going to be less than the interest due for the period. But of course, again, you know that something is going to give. The unpaid interest adds to the balance of the loan so that your loan balance continues to rise over the course of the loan. Anyhow, it could also be a home equity loan, which is a second mortgage loan that you're taking out. It's a type of consumer loan, really, but it's backed by the property that you already possess, as I indicate right here. And then here's another interesting one, reverse mortgage loan. So I give you a little illustration here. What the heck'em? What's heck'em? Home equity conversion mortgage, which is the same thing as reverse mortgage. So described right here, illustrated right here. So here's a good old gentleman. He owns this property, fair and clear. But hey, he says he goes to the bank and says, "Hey, I want you to give me $100,000," and it's actually a loan and not a loan. It's not a loan because if he gets this bunch of money, he's not going to pay it back. It's obviously a loan too because it's secured by his property. So when he passes away, the bank, recovers the amounts given in addition to any interest accrued over the term of that giveaway, if you want to call it that. So the specs on HECM are summarized right there and also right here. Some of the big things to know, right? So this is usually good if for senior citizens that need some good money and they already have their property. All right, so what are the tax effects? Interest and real estate taxes are both tax deductible, right? So the interest you're paying on the loan and any taxes you pay on the property are tax deductible. And these are the major lending institutions in the United States. And right here, I give you a couple of links that might be useful if you wish to look at those a little bit more closely. Well, the federal agencies operating in the U.S. Mortgage market are summarized right here. So this is the way that goes. Here's Uncle Sam right here. And these are investors, and this is a bank. So the bank goes to the investors and says, "Hey, we can sell you financial instruments backed by the U.S. government in the form of loans that are going to be guaranteed by Fannie Mae and Freddie Mac." So in essence, these investors are actually supplying funds to the home mortgage market, which are going to be guaranteed by these stockholder-owned government institutions, quasi-government institutions, so to speak. And so now the bank gets all this money and now makes them available the uh, to the mortgage market. Again, if the loans are guaranteed by the government, then they're going to be in the form of FHA and VA loans. Otherwise, they're just going to be conventional mortgages right here. So these are referred to as mortgage pass-throughs because the money obtained from these investors passes through these financial institutions to then be made available to homeowners, either in the form of government sponsored or guaranteed loans or conventional mortgages. All right, so a quick description of the government institutions is presented here: FHA, VA, Fannie Mae, which is the Federal National Mortgage Association. That's the nickname right there. And right here is Freddie Mac, which is the nickname for the Federal Home Loan Mortgage Corporation. And finally, Ginnie Mae, right, the government National Mortgage Association. And that's really all there is to it. So you can pause the video at any time to get to know a little bit more about these government institutions that interplay in the U.S. mortgage markets.